Welcome to Restaurant Deal Making Exposed, the only show that equips you with everything you need to know about restaurant transactions. In this show, we tell you all about how to make the sale or purchase of your restaurant not just possible, but successful. Now here are your hosts, ex-restaurateurs and seasoned brokers, Patrick Toda and Andy Mirabel.
All right, everyone, welcome back to another episode of Restaurant Deal Making Exposed. I'm Andy, my partner here, Patrick. We are having an episode here on restaurant books. This is our second round, so we're calling it round 2 with Dan Engel of Engel Accounting. He is back with us, so let me dive into my little introduction here, and then we'll get to say hi to him again. There are 2 major trains of thought when it comes to restaurant books. Tactic 1, how can an owner pay less taxes? Tactic 2, how can an owner reflect a strong value of their business through their books and tax returns? Well, in our restaurant brokerage world, we see both kinds of books. Typically, it is the clean, above-board books and tax returns that help us as brokers clearly represent the true value of a business. It is easy for a business owner to run many personal expenses through their business and make those personal expenses reflect as expenses of the business, in turn, making their business look less profitable or not profitable. This most often equates to paying less taxes due to less profits at the end of the year. As brokers, we regularly have to recast our clients' financial statements to show what the true profits for a new owner could be. This is often easier said than done. In short, a business owner needs to decide how they will manage their books and tax returns in their favor. But sellers beware. Benefiting in the short term in tax savings can often have an adverse effect on the value of your business when it comes time to sell it. Today, we're happy to have repeat guest Dan Engel of Engel Accounting back with us to help us unpack the benefits and detriments of each style of bookkeeping. To remind our listeners briefly, this is Dan, Engel Accounting. His website is engelaccounting.com, E-N-G-E-E-L accounting.com. That's my plug for you, Dan. Dan is a restaurant accountant extraordinaire and represents many top Bay Area restaurant brands, chefs, restaurant owners, and such. He was previously an immensely informative guest of ours on episode 7 called Cook the Books, regarding the do's and don'ts of restaurant accounting. So please check that episode out as well. All right, let's dive in. Don, welcome back. We're so happy to have you here. And I know you and I have a long history of working together. So I holds you in the highest regard of your opinion and expertise. So thanks for digging into your busy day and coming on the show with us again.
Many thanks for having me back. Really, really excited to be here.
All right. And then my partner, Patrick, who hasn't said anything yet. Let's get to it.
Yeah, buddy. I'm trying to get a word in edgewise here.
I know.
Don, thank you so much for joining us again. I really enjoyed our last conversation. I'm sure this one's going to be pretty good too. Tell me, when you go about doing the accounting for your clients, do you help them with recasting and all the personal expenses? And how do you advise your clients regarding that?
Yeah, so I'm kind of I sit somewhere between the client and the CPA, and we try to find a balance, like you said, of, okay, we're going to push the envelope to what is a business deduction. We're going to load up the books with as many deductions as, we can conceivably have to show less profits to save you on taxes. Yeah. And most of my clients are LLCs. They're also small LLCs, maybe a single member LLC or just one other partner. And then I have a very few who are larger LLCs with many partners, upwards of 10, 15 partners, things like that. Yeah. And that also makes a difference. The smaller LLCs really push that envelope as hard as they can. They would like to run their entire lives through their business. And so we do a great deal of sifting through all the expenses and the transactions, and we try to protect them. We don't want to, load the books up with too many personal expenses.
Are you saying that antique, 2-door Mustang from the 60s is not a work car that they're putting the auto expense through?
Well, it can be if you leave it outside as kind of like a showpiece,
to
right?
attract, yes.
Yeah. So what are acceptable add backs? I know with, let's say I'm eating out at a restaurant, and I'm checking out the menu, what is that an acceptable add back? Is that doing some research and development? What do you consider to be reasonable add backs? And also on the eating out, now it's my understanding that Trump changed that to 100% deduction. Is that true?
Yeah. So personally, I'll do whatever the client wants. Now, if you ask the most strict CPA,
Uh,
and you brought up a fantastic example, which is research and development. We also call that market research. We label it different names, and it's basically the owner eating out. And the strictest CPA will throw that out the window.
Yeah.
It says, no, that's meals and entertainment. We're not gonna take 100% deduction on that. To answer your question, the IRS, I think it expired last year. I think they made 3 tiers of meals and entertainment. And there was one that if it was office meals, you could take it at 100%. I think that's expired, but I'd have to consult with a CPA to be sure. So currently, I don't think there's any 100% deduction for meals unless it's like a staff party.
Got it.
Yeah, you'd have to show
And
that.
We used to dump so much into that when we worked together from every company we worked with, Don, to get collectively when we were doing that. And I won't name names, but certain owners with their travel and their meals and it was a staggering number they were trying to feed back through one restaurant location.
yeah, but I have to say that like when I've gone to restaurants, when I was in the restaurant, when I owned a restaurant, when I've gone to restaurants and I've eaten something, it does kind of trigger, an idea for a menu item. Or like I was traveling in Mexico and I ate like the best taco ever. And I was like, I know a sandwich I can make out of this or something like that. So it does to me seem like there is something there that you should be able to get some, research out of.
Not to poke at you, Patrick, but I don't think there's a creative department in the IRS. You know what I mean? Like, I don't think there's a department going, I wonder if you got a good menu out of this meal, So I think I think they've really tightened this up a little bit, haven't they, Don? Where you just can't be throwing all these things in here and getting 100% deduction.
They have. Now that said, I currently on all of my restaurant books have a research and development line. And yes, we categorize all the owner's meals to there. And then we hand it off to the CPA, and the CPA gets to make that determination if they want to allow it or not. And I'm not sure how they decide. I have only one CPA who's thrown it out. The other 3 that I work with are happy to keep the categorization, give you the full deduction. And Patrick, like you said, they'll stand up for you if under audit. And they'll say, look, this is what it was. The owner, went out, they brought this information back, and they developed their menu based on this. So we're going to hope that it holds. And it's up to the IRS auditor. So that is one of those unique accounts that we use, that we keep it currently. And I guess, do you guys, so when you see market research and development, do you pull that off as a owner expense and add it back to the bottom line?
I do.
As brokers, we do. SBA is not going to accept that. Right, Patrick?
Yeah, SBA. So that's a big, big thing here is like, there are many things that we would consider adding back. However, if we're trying to get a business pre-approved for an SBA loan, there's a good chance that some of those deductions that the SBA will not use when they do their evaluation. So there's kind of 2 different considerations that you have to, to get around there.
They're much more strict on what they will accept and what they won't. Whereas we know that if you're running your car payment through the business, that's your Cadillac at home and not your delivery van, that we do add that back, because a new owner can come in and be like, well, I'm not going to do that. And that's going to hit my bottom line. So that is something I can perceive as profit.
On that note, there's also like 2 different train of thoughts with the SBA. There's, more conservative kind of approach from one, particular SBA lender. And then there's probably another lender that may consider more taking those ad backs, but you just really have to be able to justify it and show a paper trail and really show that it's not a true expense of the business. And I think if you can document that, it's going to show well to both the buyer and to the SBA, because, you just got to have that. You got to be really able to show that it's not an expense of the business. Yeah.
Yeah. And great segue. So we have a handful of accounts that I guess, I don't know if this is the right timing, but I wanted to run these by you. So typically owners run, and it varies to degrees, like not all owners do this, but so home groceries,
Yeah.
Yeah.
They're in the food industry and they're like, look, if I'm at whatever Whole Foods and I'm buying groceries, can I put it on my business credit card? And I kind of shrug. I'm like, yeah, it's going to destroy our cost of goods. I won't be able to give you a good cost of goods
Exactly.
number.
Do you keep it separate so that you can track it?
I don't.
That's a lot of extra work for you. And then they're logging accounting hours, right?
Yeah.
We get into some of these categories where it's a little too diluted. And for us to extract receipts and look at bank statements, I think we're getting to that point where it becomes really ticky-tacky. And I think that's when a good example of when I may say, hey, Mr. and Mrs. Restaurant owner, you've benefited from your habit, but I can't do anything with it come time to sell. With that particular example.
Yeah, that's exactly. It's so mixed in there. Like I can't go in and pick out all of the grocery shopping. I don't even know how to recognize it. Or maybe conceivably we could, but also, Andy, like you said, it would be so detail oriented and take so much time. And it's like, come on.
And someone's going to ask why their accounting line is so expensive. So,
Exactly.
Yeah.
We have an account called Restaurant Supplies that we use, which is kind of a catch-all for any supplies that we don't recognize. And I couldn't even tell you, because it is such a catch-all, how much restaurateurs run through this, Actually, lately it's been a little bit easier because everybody shops on Amazon. So I'm like, what's all this Amazon? Is it really coming back to the restaurant?
Yeah.
Yeah.
There's that one. Office supplies is another one where, hey, they'll call me from, I don't know, Best Buy. Can I put this computer? It's for my personal, but can I put it on the business? And I'm like, well, I mean, what do you want me to say? I'm not.
Yeah. I think the conversation there is like, I'm buying a new computer for my business.
Yeah. Then use it personally.
Oh, yeah. Owners, I don't know why, are usually overly honest with me. And I tell them, like, no, it's not really a business expense. But, I'm not there at Best Buy and I can't I can't stop you from swiping that card.
Can you share some conversations you had with Andy when you were doing his books?
I was on it except a couple of restaurant meals, Patrick, all right? There's a lot of market research.
Was his wine line really, really heavy?
It's called samples from vendors, Patrick. Okay? Yeah. I would change my wine menu every 2 weeks. No, I'm just kidding.
You're really going through a lot of sake, Andy.
I know. What is it? So, Patrick, what do you think? Like when we say we want to see a nice, clean tax return to really project the best value, what does that look like to you, Patrick? And then we can obviously bounce that off Don.
I think what looks like the perfect scenario for me is when you're basically adding back what we refer to as EBITDA, right? So it's basically only owner pay, interest, depreciation, and amortization, right? And you have a nice clean P&L and a nice clean tax return, and you're basing it off of that EBITDA number. I'm going to go a little higher on that valuation. So that's what I shoot for.
Less surprises.
And it shows well to a buyer. And it's, the perception is like, this is a really clean business that I want to buy. You're going to show it to the SBA lender. They're going to be like, wow, this is a slam dunk. To me, that gets a higher valuation just right off the bat.
Do you concur, Don?
Yeah. So, let me turn it around as a question. So some things that are legitimate that people run through their business are, car leases and telephone are good examples.
Sure.
Where, sure, you're running your whole business off of your cell phone. There's no reason why it shouldn't be running through your business. I imagine you guys add those back.
Correct.
Let me throw that back at you then, because if you're talking about like a phone inside the store being a true business expense, so is it time that we start to just use our cell phone as a true business expense? You know what I mean? Because everybody's going to have that expense, right? It's not like a new buyer is not going to have that expense because they're going to get the same calls from the same restaurant. And so maybe that is just now at this point, a true expense.
I would
agree
with that.
Andy?
Yeah, absolutely agree with that. I mean, we talk, you brought up, the two examples you just said, Don, but, owner health insurance is another one that I'm always going to add back, right?
Yep.
That's a biggie.
Health insurance is a great topic. We could probably do a whole show on it.
Yeah.
It's so confusing for people. So what's supposed to be on your books is group health insurance. If you have personal insurance or if you have insurance through a spouse, that should not be on your books. And then tax-wise, health insurance is taken as income. So your CPA actually, similar to you guys, they pull that off the books and recategorize it as income on your K-1.
That that a business owner is taxed on?
Yeah. Mm-hmm. And,
So you're saying that if I own a restaurant and I go out to the open market to buy health insurance for me and my family, that isn't an expense that we should add back?
that should not be on your business P&L.
Got it.
Yeah.
It should be on your personal side.
Exactly.
But then Patrick,
Interesting.
I still would think that you and I would, for our purposes, would back that out. It's a benefit.
I would back it out.
Yeah, exactly. Okay.
But I have had conversations with SBA lenders who say, well, you can back it out, but guess what? The other, this person's going to need that expense too. And I'm like, well, maybe they get, health insurance to their spouse, or, maybe they're going to have, it's controversial, I think, but I do add it back.
Yeah.
Here's the $1 million question for today. So let's kind of revisit this. I briefly touched on it in the intro. Which
Andy,
benefit?
you're dating yourself. With the $1 million question. I mean, that's very 1980s.
Okay, I didn't think of a new catchphrase yet. Okay, I said I was born in the 70s, and my daughter almost fell out of her chair the other day.
Yeah, trillion.
Yes. Okay. All right.
Just barely in the 70s, Andy.
Yes. Exactly. Here's the Googleplex question of the day. That's my 6-year-old would say. Okay, so we talked about in the intro the two kinds of trains of thought with the restaurant books, but which method benefits which kind of owner? Does a long-term owner benefit more from less tax liability? And my point is with this, we can't predict the future. Restaurant success rate is very low. And if I had a crystal ball and I go, you know what? I'm going to put my blood, sweat, and tears. I'm going to be operating this as the head chef or owner operator for the next 15 years. I choose to run my books with as many personal expenses as I can put through them so I have less tax liability over, the 10 to 15 years. That could add up to a pretty big number. We don't have that crystal ball though. So what is our risk here? Because if you do want to sell your restaurant in X amount of years, you really want to set it up for success and have no less than 3 years of really healthy looking tax returns and P&Ls. Is there a right answer here?
There is no right answer. It is something that owners should have that conversation with themselves.
Yeah.
They should sit down and think about their end game. Like, am I expecting to have this for the next 30 years? Or, hey, maybe things are going south a little bit. I need to prepare now to sell this in 3 years. Most of the people I work with, and I don't think I bring this up enough, talking about how, we have a 1-year projection, but let's talk about your 3-year projection and where you see this going. That is such a great topic. And I think if people did think on the long term, they would invariably come back to, I need to clean up my business and consider, what it would look like to a buyer, consider, what my tax returns look like and what the buyer would see when they looked at that too.
I think also just, there's another part of this whole thing. Even if your plan is to be in business for a long time and grow your business, I believe that having clean tax returns can benefit you as a resource, because when you go to sign a new lease, if you want to, grow your business, you're going to be able to show that landlord how successful you are. You're probably going to get a better lease. They're probably going to want to do business with you. You're also probably opening yourself up to more, loans or, capital that you may need to kind of grow your business. Obviously people want to do business with people who are showing to be successful. And so you really do have to rack your brain and say, what is it that you're trying to do here? Because if you have really clean tax returns, it can be a resource to you along the way, even if you're in it for the long run.
That's a fantastic point. Absolutely fantastic. And on the flip side of that, if you don't, Don, are we not opening ourselves up to audits and other things if you're just putting too much crap through your P&L and trying to pawn it off on your tax return? I mean, aren't we more at risk?
You absolutely are. And Patrick, that was so beautifully said. Yeah, there are, beyond the benefits of making my job a little bit easier, there's the SBA to consider. And at this point, a lot of our restaurateurs need loans just to get by until things turn around for them. And also the landlord. I wish owners sat down and ran the numbers before they entered into a lease. So negotiating a low, reasonable lease is key to the success of a business. And the landlord's going to want to see your tax returns. And just like you said, they're much more apt to go with somebody who's got clean tax returns, who's showed profits from their business. They're reassured that that person's going to stick around for a long time.
And they're above board. They look more honest, don't they, when your tax returns like this?
Yeah.
And you might actually get around to doing a personal guarantee on a lease, because they're seeing that your business, your LLC, is successful.
A corporate guarantee.
A personal guarantee on a lease. Basically, if you have clean books and you're going in as an LLC, you can say, "Hey, I'm not doing a personal guarantee because look how successful I am," and they may consider that to stand on itself and not have to come after you personally.
That's a good point.
Really good point. And then back to you, Andy. Yes, in my, I don't know, maybe 20 years, I don't know, I've been through about 5 or 6 IRS audits, and they, in truth, they go for the big stuff first. So they're looking for the larger transactions, tens of thousands of dollars. They want to see backup for that, because that's where they really...
Where are they focusing? What area are they focusing on?
They're really focused with large purchases, so fixed assets.
Uh-huh.
The next thing they go for is your payroll. So with restaurants, they're making sure that your tips are really close to your credit card tips. That's where a lot of restaurants, we pay cash tips and we declare 8%. I thought that was the guideline. And what the IRS does is they come in and they look at your credit card tips and they say, hey, it looks like you're bringing in 18% on average with tips, and you only declared 8. So where's the difference?
And which is a big number over 365, right? I mean, that's a big number.
Really big
Don,
number.
I want to ask, and we can talk about this later because I don't want to cut you off, but I do want to park this. Yeah. I'm really interested in this whole tip.
I was going to bring this up.
Yeah, the tip credit, this new thing with Trump and everything. But I just want to, because it sounds like, because you get a deduction every year anyway. So the tip credit that Donald Trump is talking about doesn't actually save tipped employees all that much money in the long end, unless they're making a lot of money, right?
I'd have to look up to see what the president is talking about with this new tip credit situation. There is an existing tip credit that employers get. So you submit I think it's a FICA report from your payroll agency. You submit that to your CPA, and I don't know what the calculations are there, how much you save, but the employer saves some money on the current tip credit. And I think you're right. I think there's a new proposal for
not taxing
tips, right?
Yes. Yeah.
Well,
and I don't know.
You get an automatic $16,000 deduction as an individual. And so it's my understanding, if you do the math, unless you're making a lot of money on tips, it ends up saving you a couple $100 or something like that, because you have to get over a certain threshold.
I think you're absolutely correct. Yeah.
Okay.
The personal deduction is so high now. Nobody's really gaining much. Mm-hmm. We were talking about audit. Okay. Yes. Sorry. Back to you, Andy.
Oh, no. Please continue. I thought.
Oh, yeah. So we were talking about audits and what they look for. So fixed assets and payroll are the two they focus on. And so a lot of these small knickknacks, you kind of have to hold your breath through the audit and hope they don't catch you. But typically they're small enough that they're not going to, unless you went out and bought a $5,000 computer and they're like, where is it?
Yeah. No, I mean, I have clients like this. I have a client right now, and our buyer is going through SBA pre-approval, and I absolutely held my breath, because I think I maybe have talked to you about these clients, Don, and they had a bad accountant experience. They got a new accountant. That accountant was a bad experience after refreshing their books. And we go back to the SBA once we have current P&Ls and tax returns. And, it's very clear on the new books, that they've run so many personal expenses, their home rent, their car payment, all these things through this, that I'm holding my breath that this, this application for the buyer is just not going to go through. Fingers crossed, it's going well so far, because the books are strong enough, but I was holding my breath for sure.
Yeah.
When you take on new clients, Don, how often, what do you see when the books come to you? One, I know you probably want to get them into your formatting and your, how you do your books and your company does the books. But what do you see when you get these new clients on, and how much work is it to get it cleaned up and get it to the way you like it?
Yeah, I very rarely get a good set of books. And it's just appalling what's happening out there. I don't think a lot of bookkeepers have a degree or any accounting school knowledge. And so they're just going off of what they've seen before. And so that's the biggest difference. And usually it's a bunch of balance sheet work. So the P&L kind of gets cleaned out each year. Every 2 year you do a tax return and you start with a fresh P&L on January 1st. So that's not really a big problem. Balance sheet accounts carry a balance. Like you ask yourself, well, what's the balance in my checking account? It's on the balance sheet, and that balance is continual. It's going up and down every single day, year after year. And that's true for all the accounts on the balance sheet. Well, if a bookkeeper leaves, $1 on the balance sheet that doesn't make any sense, we have to track down what it's about, and we have to figure out how to get it off the balance sheet. We do that by writing it off. You've probably heard that term a lot, to the P&L.
Yeah.
That washes it out and following.
Those are so ugly. Those are so ugly.
Yeah. And so when I have some books transferred to me, I dump all these things in period 1 or something like that in January. And the owner, when I present them with the January P&L, they're like, how did I lose $50,000 in January? And you're like, well, it's been sitting on your balance sheet for 30 years. So.
We had to get it off the balance sheet, essentially, right? Yeah, I've heard that phrase quite often at the end of every year or the beginning.
Those are the biggest ones.
Yeah.
And that kind of plays back to what we're talking about, having clean tax returns. So you need a combination of a good CPA and a good bookkeeper that they don't allow these things to pile up. So the CPA would ask the bookkeeper, like, well, what does this $50,000 represent? Do you have it in an account called accruals? Are you really accruing something, or is it a mistake? So the combination of both capable people will have a good, clean balance sheet, which translates to good tax returns, which translates to getting the better lease, getting the loan, and all that.
Yeah, no, totally true.
Right. Mm-hmm.
I think this kind of leads to our last episode that Patrick and I did, and we actually got some of your insight from it. But you can go beyond a yes or no on this one. But in your experience, do most clients think their business is worth more than it actually is worth?
Oh, yeah. So yes,
he was very excited about that. He's like, oh, yeah.
Very, very. I can't wait to see the last podcast you did on this topic. Absolutely 100%. It's really hard for them to chew on when you guys show up and you're like, look, we're presenting you with a number of what we think people will pay for your business. And they're like, that's it?
Yeah. And again, Patrick and I will clarify this till we're blue in the face. We want to get the highest and best for our clients. And we really do. We fight for that. We really do. But there's reality. There's what buyers will pay. Dawn, your contribution to me when we were giggling on our conversation before my last episode with Patrick, you said basically, your contribution was this. When you get a valuation from a CPA or a third party, they're often using, balance sheet based formulas, book value. And you said that balance sheet valuations, they're getting the value by adding up the assets in the books, the liabilities, and the equity equals the value of the business. And it's wholeheartedly that's not grounded in reality of what a buyer will pay, right?
That's so true. I mean, everybody puts every cent they have into their business, hoping that it will succeed. And unfortunately, when it is time to sell, that's not the market value.
Especially in restaurants. There are so many second generation restaurants that are like new, fantastic equipment inside, and you can buy them for 10% of what, if they're a struggling business or an asset sale, but you can buy them for 10% of what they originally invested in it. It's just, there's so much out there. So the value really does deplete quickly when it comes to restaurants, unfortunately.
On an asset sale. Yeah. On an asset sale, right? If you're doing a going concern and you are showing, as we've talked about in this episode here, that true profit, you're going to get a multiplier on that profit. And you're going to then see the value of all your hard work and what the assets are truly worth. So again, another reason to show those profits.
Yeah. I think between us three here, we have a general consensus that, we would prefer clients to be above board, have really clean P&Ls and tax returns, because we see all the benefits for the future and the different opportunities that arise when you have clean books, tax returns, and the added value to your business. So I don't want to speak for both of you, but it sounds like we're kind of in the same court on this one. The other method, just to recap a little bit, is maybe a mom and pop shop most likely is going to run a lot of personal expenses to limit their tax liability. So really, in conclusion, take some time to think what's best for your future. Don't think in 1 year increments. Think macro, right? Yeah. So, all right. Well, Don, you're amazing. We love having you on.
I would love to say that was the most beautiful summary.
Oh, thank you. Thank you.
That summed it up perfectly, and I agree wholeheartedly. And my takeaway from this is I'm going to sit with my clients at the end of every P&L meeting and say, hey guys, let's talk about the 3-year projection. We just talked about the 2-month projection. Yeah. Let's talk about 3 years.
Yeah. And we work in 3-year increments when we're really reviewing the value of a business. So that's a good thing. Yeah.
Don, can I ask you a quick question since we have you here? What is the benefit of having like a fiscal year that ends in the middle of the year? Like if someone does their books from, October through September, like what is the benefit of that?
Yeah. So I think that's only allowed with C corporations. I'm not positive. I'd have to go back to my books to see. And the advantage of that is a very short-term tax deferral. So let's see. The example that's coming to mind might be for like secured property tax. You have the option to, prepay it. And so you can this is talking about personal taxes. You could load up that expense in a previous year so that you can decrease your tax liability. By having a fiscal year, it kind of shifts all your expenses, back. So you're completing your tax return in the middle of the year. It only includes expenses through June, and you're not paying that until, the following year. So I'm not explaining it very well.
Okay.
It's
putting a level of deferment on something that is owed, which could be a benefit in the short term, it sounds like.
Yeah. Well, it's kind of
maybe you're taking
taxes usually in April, for an individual, and that's when you're paying. You're shifting that forward. So if your fiscal year ends in June, you're not completing your taxes till June, July, August, September, like October. And so you've kind of pushed off your tax liability a couple months. That's it. Yeah.
Okay. I've got a couple of clients that have this right now, and I was just like, this is totally random. Why do I have 2 people right now that I'm working with? Yeah, so I haven't seen anyways.
Oh, interesting. Yeah, I don't see that often ever, actually.
All right, Don, we got the bonus question for you this time. This is this is very targeted towards you. We've shifted to having dining questions and, dining experiences and such. So, Don, do you have any beloved Jewish dining traditions or experiences that you can share with us today and our listeners? Whether it's at home or something you do each year on a holiday, is there anything that you can share about your culture?
Oh, what a lovely question. Yes. So I think with probably any culture, it's all centered around food.
Yes. True.
That is absolutely true.
And in the Jewish tradition, the joke is, we suffered. Great. Let's eat.
I like that. What do you guys eat when you're home? Are you big cooks at your house with your family?
We are. My wife, I think she would say she makes the best matzo ball soup. Her chicken broth, though, she learned from her Roman Catholic Italian grandmother.
Hey, I'm Italian, so, I know it's good broth. That's amazing. Well, I'm going to have to hit Angela up for some of that broth so I can use it.
Come over for some matzo ball soup.
There we go. All right, Don, we love you so much. You're so informative and a wealth of knowledge, so thank you so much. It looks like we're going to have to prepare ourselves for round 3 in sometime in the future, all right?
I think so. Yeah.
Thank you, guys.
Right on. All right, everybody, tune in next time for another episode of Restaurant Deal Making Exposed, and we will see you all next time.
If you enjoyed today's show and don't want to worry about missing an episode, you can follow the show wherever you listen to your podcasts. And if you found today's episode interesting or useful, please share it with someone you think would benefit and consider leaving a rating and review.
Reviews help restaurant owners or buyers just like you discover this podcast and benefit from the important topics covered in the episodes. Your opinion matters to us as a listener. So feel free to leave topic suggestions and feedback for us, as we will use these to tailor the episodes to you and help you get the most out of listening.
Thank you all for listening to this week's episode of Restaurant Deal Making Exposed. If you're considering selling your business and would like a free consultation, reach out to Patrick and Andy at therestaurantsalesbroker.com or visit www.therestaurantsalesbroker.com to learn more.